Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm here today with Steve Farr, formerly of NCUA and currently of my team at Credit Union Exam Solutions. Steve, how are you doing today?
I'm doing all right, getting used to the colder weather up here in the north.
Yeah, it seems to be hitting most of the country. It's that time of year, unfortunately. But if you like to snow ski, I guess it's a good thing. So, Steve, today we're going to talk about the National Credit Union Share Insurance Fund versus the Deposit Insurance Fund, one of which is for NCUA and the other is for banks. And but before we jump into that, why don't you give a little bit of your background as it relates to this topic and or just what you did at NCUA in general?
Yeah, I decided that to delve into this topic. It has to do with my back 30 plus years at NCUA and dealing with, as a problem case officer, dealing with the assistance that was offered and available through the NCUSIF. And then as my career went on in the central office, I started dealing with helping to manage the equity ratio of the fund. And I found myself in a lot of times doing comparisons to the deposit insurance fund to make sure that I wasn't missing something that they were seeing coming along in the future. Those duties that I had made me always interested in contrast and comparing the two funds, and thought maybe I'll share some of that information on this podcast.
Yeah, that sounds good. I'm looking forward to this. This is right in your wheelhouse from all that knowledge that not a lot of people have about one or the other, but because of your role at NCUA, you know a little bit about both of them. So why don't we jump in and talk about what the purpose of these funds are, which I think a lot of listeners will know, but it's a good way to maybe start it off.
Yeah, as it goes back early, they're both set up to maintain public confidence in the U.S. financial system and resolve failed banks and credit unions. And so that if you look back prior to deposit insurance, banking and losses was like operating in the Wild West. You either had a good institution that did fine, or you were in one that involved a lot of fraud and you ended up losing your deposits. They wanted to have stabilize our deposit system, and thus the use of deposit insurance.
Very good. Yeah, I was watching a documentary, Wyatt Earp on Netflix. It's a four-part documentary about the Wild West. It was about Wells Fargo and shipping gold from, or excuse me, shipping silver from Arizona, and the stagecoaches coming to the East Coast, and how that played a role in the U.S. financial system, in the economy being built. And of course, back in the Wild West, there was no deposit insurance. And like you said, if you picked a good bank that stayed alive, you were lucky. And if you had one that failed, you could lose your life savings. So it's a great system that we have here in the United States. But let's talk about the National Credit Union Share Insurance Funds and the principles of it, when it was started, how all that works.
Yeah. That one was back when the Federal Credit Union Act came into place, with what, 1934 or something like that. You might know the exact date. I didn't write that down. It was established, and it is managed. The fund is managed by the NCUA board. And like we say, the purpose to ensure deposits of all federally insured credit unions. And the thing about it is that the fund is backed by the full faith and credit of the United States government, which is a real important item to have specifically included in the act. And then I did all the numbers as of the end of 2023 for comparison's sake, because I could work off of audited financial statements. The insured shares at that time were 1.7 trillion in the credit union system. So then if I go and compare that to the deposit insurance fund, their thing is insures deposits of insured depository institution that resolve failures upon appointment as receiver in a manner that will result in the least possible cost to the deposit insurance fund. That's their directive. And at the same on 12/31/23, they had a 10.6 trillion in their insured deposits. So it's like 617% of the insured deposit of the we'll contrast and compare them a lot based on kind of those, how much bigger the deposit insurance is than the NCUSIF.
That's interesting. And by the way, I don't know the exact date of when that was signed, but I do know fun fact that the picture I use on LinkedIn with me standing in front of a flag, and I also use it as advertising for this podcast. That picture was taken at NCUA's celebration of the signing of the act in 2019. However many years that would be, it was some odd five without doing the math. But anyway, yeah, it's been in place a long time. It ensures a lot of deposits as the deposit base keeps growing, and that's a good. It's good you've got that data there, so we can walk through it as we walk through different things here. So you mentioned that you got involved because of your understanding of working with troubled credit unions and providing insurance and assistance from the NCUSIF. Could you touch base on that? What that actually means for the listeners?
Yeah, and it is one of those evolving things, and a lot of the work I did as a problem case officer in resolving troubled institution was pre-prompt corrective action. So some of the items that we did then are less likely to occur now because of the change in capital requirements. But the NCAA still has the ability to do the items that were included there. So items that included assistance would be waiver of statutory reserve requirements, liquidity assistance in the form of a guaranteed line of credit. And that would be as a very last resort that the insurance fund would guarantee the line of credit. It would just be for a severe troubled institution liquidity problem, cash assistance in the form of a subordinated note. And that would be that basically it's investing in the institution for a limited period of time. One that doesn't occur much, and it's always a problem thing there, in that if the government is supporting an institution that's competing against other institutions that don't have government support. So that's why that one is less used at this point in time. And a big one that you see a lot is merger assistance in the form of cash assistance, purchase of certain assets by the NCSF out of a troubled credit union, and guarantees of the values of certain assets, primarily loans. But that
Yeah,
is
and
not necessarily the assistance that's available.
got it. And loan guarantees, that's something that I did, I think, quite a bit before you and I started. But then what had happened, as I recall, is they stopped wanting to do loan guarantees because it became complicated for the audits that NCUA would have done. But the cash assistance, so those would be examples where credit union is in danger of closing, has poor net worth, and NCUA is actually involved in shopping that institution, and someone comes in and prices the assets. That would be an example of the merger assistance. On the liquidity assistance, you mentioned that's not used that frequently. It used to be used more. I remember back in our problem case officer and director of special actions days, we'd get phone calls from the corporate saying, "Hey, this credit union here, we're worried about their financial statements," because to get the loans, they would provide their financial statements. And then they would call, we would work with the central office, and then a guarantee would be put in place where the insurance fund agreed to guarantee any loss there. At the end of your career, was it working different? It was less frequent, but were the mechanics generally the same?
The mechanics would have been the same. It's just that fewer institutions would get into that position anymore because the corrective action starts so much sooner.
Right.
And once capital gets below 6, everybody's interest gets elevated, and those problems tend to get resolved quicker.
Sure. That goes to prompt corrective action, which requires them to have the capital, so situations get brought to a head quicker.
I was going to point one of the issues, I think, when we do the merger assistance, and then sometimes they'll put them out for basically competitive bidding. In NCUA, we like to do the deals where you give us a deal as to how much, what is the assistance that you need, and do the one-time kind of deal on that, because of the incentive is so great for the continuing institution to maximize the value of that. And I'll contrast that. I'll talk quick about what the FDIC really doesn't do assistance, because those are for-profit institutions, so they don't tend to want to prop up for-profit institutions versus ours being nonprofit. But their institutions are placed into receivership. They're currently managing 74 active receiverships, but their resolution in using purchase and assumption transactions with shared loss agreements is what they use predominantly. There's a difference in how liquidations and resolutions can take place.
Got it. Got it. NCUA cashes out and FDIC does loss sharing.
Mhm.
Got it. Got it. As far as liquidations and resolutions of institutions, that kind of goes into that. Is there anything else relative to that you want to touch on?
Yeah, for liquidations on the NCSAF side, they establish an asset management estate, and those are generally run by our AMAC that down in Texas there. So it says that unless expressly guaranteed by the NCUA and backed by the full faith and credit of the United States, the AME's unsecured creditors, including the NCSF, could only expect to be paid if recoveries from the asset management estate are efficient to be distributed to unsecured creditors in order of priority, which is included in the regulations. And if not a straight liquidation and total payout, most liquidations are completed using a purchase and assumption agreement so that there's just a nice kind of clean break for the continuing institution that's only absorbing those assets and liabilities that they specifically purchased, protects them.
Got it. Got it. Yeah. And if they don't purchase it exactly as identified it in the documents, it falls upon the insurance fund, which is a smart
Mhm.
way to acquire something if there are unknowns. So, of course, you mentioned the dollars that are in each insurance fund, and they're funded differently. Credit unions fund the NCUSIF different than how the DIF is funded. Can you talk through that?
Yeah, this is probably like the single most different item in between the two funds is how they're funded. And we're probably aware that 1% of insured shares are required to be deposited into the NCUSIF. So that is the lion's share of the money in the insurance fund. The NCUSF can assess premiums to all credit unions as provided in the act. We rarely ever do that. Investment income is the big source of funding. When we had guarantee fees that were active in the corporate resolution that were providing income to the fund. And then, of course, as we get recoveries from the asset management estates, those can contribute to provided everybody else has been paid according to the priority. The source of funding is the authority to borrow from the Treasury and from the NCUA Central Liquidity Facility. The NCUSIF can borrow up to $6 billion from Treasury, but in times of extreme duress, that can be raised. It becomes very difficult and quite political at that point.
Yeah, that's an understatement. It does become political back in the Great Recession. NCUA was using every trick in the book to try and provide liquidity to credit unions, and then also got some relief through the acts of Congress that have since sunset, as I recall.
Then the difference being there that the deposit insurance fund is primary source of funding is assessments on the insured depository institutions, and then they have their interest earned on their investments, and they too can borrow from Treasury, and their borrowing authority is 100 billion from Treasury. Very much more. They do have significant more exposure in terms of that too big to fail type problem that they deal with, that raises the specter of needed extreme amounts of liquidity.
Sure. That makes good sense. NCUA last recently did their budget briefing, and there's a slide in their budget briefing where they compare the costs of NCUA's exams and the assessments of FDIC and OC, et cetera, for operation. And every year when they show it, it shows the cost of being a credit union is less than the cost of being a bank, which is used to calm the nerves of the trade groups whose NCUA's budget is too high, which they say every year. But then that data shows some context. There's peer groups for credit unions. The FDIC is essentially the only peer group for NCUA, but that's another rabbit hole
Yeah.
that I thought I'd touch on. There are certain statutory ratios which are required, like the equity ratio. You mentioned the normal operating ratio and that you've been involved in that NCUA in the past. And there's something called the available asset ratio, which I'm showing my age. I'm not remembering that one so much. So anyway, let's talk through these statutory ratios a little.
Yeah. So each of the fund does have some statutory ratios that they have to deal with. For the NCSIF, the main one is it's the equity ratio. It's the amount of the fund's capitalization, including the 1% capitalization deposit and retained earnings of the fund. And it says net of direct liabilities and contingent liabilities for which no provision has been made. Now that sounds pretty simple, but there's been a few times, like during 2008, 2009, where we had to deal with what exactly was it mean net of direct liabilities and contingent liabilities for which no provision has been made, because there was some significant exposures out there that was hard to determine if that they would fall under that or not, but those were resolved. And that's taken to the aggregate amount of insured shares in all insured institutions. Now, if NCUA projects that the equity ratio will fall below 1.2% within 6 months, the board must establish and implement a restoration plan within 90 days that will return the equity ratio to over 1.2% before the end of an 8-year period, beginning with the implementation of the fund. So we did have to do one of those back in 2008 or so. I worked closely with some of our other people in putting that together. What NCO is in pretty good shape on that, and through the natural adjustment of the 1% and improved earnings, there wasn't a lot of additional assessments that had to be made to get back to that point. So now the equity ratio is the measurement. And then NCUA sets the normal operating ratio using the equity ratio as that measurement. And the normal operating ratio means the equity ratio specifies by the board, which shall not be less than 1.2% and not more than 1.5%. The normal operating is the NCUA board's target level for the fund. And the board has set the normal operating level at 1.33%. And at the end of 2023, it was 1.30. And the board may declare a distribution for the year-end equity ratio exceeds the normal operating and the available asset ratio exceeds 1%. So I might as well explain the available asset ratio, which is a lesser known and rarely comes into play, but it's statutory, is the amount determined by subtracting one, direct liabilities for which no provision has been made from the sum of cash and market value of unencumbered investments to the aggregate amount of insured shares, and that must remain above 1%. And that ratio was 1.22% at December of 2023. That's the statutory requirements for NCUSF. And there are similar ones for the deposit insurance fund. They have their equity ratio is called the designated reserve ratio. And it's the total of the insurance fund divided by the total. They use the term estimated insured deposits for the industry. Their act requires the FDIC board to set a target for the DRR annually. The FDIC has broad discretion in managing the deposit insurance fund, including the level which the DRR designated reserve ratio is set. The required minimum ratio is 1.35%. There is no upper limit on the reserve ratio and thus no statutory limit on the size of their fund. The FDIC Act provides for dividends from the fund when the reserve ratio exceeds 1.5%, but grants the board sole discretion in determining whether to suspend or limit the restoration or payment of dividends. Under the long-range plan, the FDIC set the DRR at 2% since 2010. Their analysis using historical fund and simulated income data from 1950 to 2010 showed that the DRR would have had to exceed 2% before the onset of the two crises that occurred during the past 30 years and would have maintained a positive fund balance and stable assessment rates throughout the crisis. Their DRR as of 12/31/23 was 1.15%. That sounds a little scary at the end of last year, but it already increased to 1.2% by June of 2024. They have another ratio too, I think, a available asset ratio that limits the amount of obligations the deposit insurance fund can incur to the sum of cash, 90% of the fair value of other assets, and the amount authorized to be borrowed from Treasury. Their minimum obligation limitation was 210 billion as of 12/31/23. So that's the statutory requirements that kind of drive some of the decision making that goes on behind the management of the two funds.
Got it. And I'm going to paraphrase some things. You tell me if I got this right. So the FDIC has broader authority to raise theirs higher. And as of right now, or the data that you have, the nearest data that you have, the looked at in a vacuum, the NCUSIF appears stronger just by the math, not looking at risks and what could impact it. But the NCUA's reserve is higher than what you just said. The FDIC's is at 1.2.
Yeah, and we'll go into that. We're going to discuss the balance sheet of the two funds, and I'll
Okay.
explain that a little bit further as it's related to recent events more than anything.
Got it. Got it. And I know you're going to talk about NCUA assessments. And I know there's some calculations. NCUA can only do assessments at certain times. And there's certain times that the only way that the fund can go up is through earnings off of the fund and operating at a surplus as opposed to doing an assessment. Whereas the FDIC, it sounds, have such broad discretion. While they might not want to do it politically, they have more authority in that area. But when you're walking through these other topics, if you want to speak to those, feel free.
Yeah. NCUA, to differentiate the two things, we have the NCUA assessments, which is really the operating fee. So that is the annual amount that the federal credit unions end up paying. It's on a sliding scale based on asset size. And of course, if you're an operating credit union, you also would be paying in your state charter, you're paying an assessment to that state regulator also. Then there's also NCUSA premiums, which are different than assessments, and those would be specifically issued to increase the equity level of the fund. And then that one, what is unique on that is that it has to charge all credit unions the same rate on a premium, and versus banks can do a risk-based pricing on their premiums or assessments. So right there, because everybody gets charged the same if the fund gets into trouble and they have to issue premiums, that is what kind of is a good thing in our industry, that it encourages everybody to look at your fellow credit unions as somebody's taking huge amounts of risk and they're large enough to affect that equity ratio of the fund should they fail. It's in your best interest to speak to them about that. Start with speaking to them and maybe speaking to the regulator that you have concerns. I think that's a nice safety check that's built into the fund.
And so, Steve,
Yep.
Steve, on the risk-based premium, so if a credit union, if a bank does commercial loans and for some reason they want to provide a different premium for those credit unions that are doing commercial loans versus not, FDIC has that ability, but NCUA doesn't.
Right. Yeah, they do have a different basis for what the assessment rate or premium rate is set for them.
Got it.
Yeah.
So on occasion, NCUA is able to pay dividends to the fund. Can you walk through how that might work?
Really, they could only do it if the normal operating level is above or the equity ratio is above the normal operating level. NCUA says we shall issue a pro rata equity distribution from the insurance fund to eligible insurance funds after each calendar year, as of the end of that calendar year, when the equity ratio exceeds the normal operating level and the insurance fund available asset ratio exceeds 1%. This says, per the Federal Credit Union Act, the NCUA shall distribute the maximum possible amount that does not reduce the share insurance fund equity ratio below the normal operating ratio and does not reduce the available asset ratio below 1%. As the fund does very good and insured shares aren't growing at astronomical levels and it's not having to do provision expenses, there's always the possibility of NCSF dividends.
Great point. And since the pandemic, share growth, deposit growth has been controlled, which does have a controlled denominator makes the insurance fund stronger. Again, all other things being equal, that kind of is a good spot to pivot into the balance sheet and what was on the balance sheet of the fund at the end of 2023.
Yeah. Before we do that, I want to talk just a little bit about the kind of the differences for the deposit insurance funds assessments. They have a statement here that their risk-based assessment system, allowing moderate, steady assessment rates throughout the economic cycles, is designed to reduce procyclicality. They're to maintain a positive fund balance during banking crises. Due to the 2023 failures, the FDIC imposed a special assessment to recover the losses to the insurance fund arising from the protection of uninsured depositors, which they did in the case of, make sure you get the names, Silicon Valley Bank and the Signature Bank issues that they dealt with.
Yes.
And it says these special assessment rates would be collected at an annual rate of 13.4 basis points over 8 quarterly assessments. Since it started this year.
Okay, very good.
They're
there was a lot
paying-
in
Now they're
ahead.
paying for those losses that were from 2013. Their assessment revenue in 2023, when they had to do some special assessments, was 41 billion, compared to kind of 2022, which was a normal assessment schedule, which was only 8.3 billion. So it shows they're paying a lot for what happened with those two significant failures. And then for them paying dividend, the law does allow FDIC to issue dividends if the designated reserve ratio exceeds 1.5%. It says the board does not intend to issue dividends, but lower assessments in the future if that would happen. Now, they are currently operating under a restoration plan that they had to put together. And due to the extraordinary growth in insured shares during 2020, caused their designated reserve ratio to decline below a statutory minimum of 1.35%. As of June of 2020, in September, the board adopted a restoration plan to restore the reserve ratio to 1.35% within 8 years. In 2020, the board approved amended restoration plan, proposed to increase an initial deposit insurance assessment rate uniformly at two basis points. So that's how they did it, by increasing their assessment rates. And they do anticipate reaching the statutory minimum of 1.35% by September 30th of 2028.
Wow.
It is not fun to be operating under. It's not fun for a bank to be out, or for a credit union to be operating under a net worth restoration plan. It's not fun for your regulator to be operating under a restoration plan. But what's good for the goose is good for the gander, I guess.
But I'm going to try and not get up on my soapbox about the failure of those institutions and how Janet Yellen and came out and said it's not a bailout. It was a bailout. They bailed out the uninsured depositors of fintech companies, and it wasn't very many companies on the West Coast. But they used an exception that they have to do it because they didn't want to have the contagion spread to other institutions. And one of the big credit union differentiators, other than the insurance fund, is that credit unions don't have a lot of uninsured deposits compared to these big banks in some instances. And that's where these uninsured deposits at the banks became so large that they had to put a plan together that spread the cost of it over 4 years, which should keep the cost of being a credit union well below the cost of being a bank. So there is that positive for credit unions. So what else, Steve? What do you want to talk about next as it relates
Let's go over their balance sheets. Because
Okay.
they're interesting that they are different. We spoke about some of these issues before. For the NCSIF, it holds 21.3 billion in intergovernmental assets. That's the treasury investments it has. And keep in mind that the lion's share of the balance sheet assets of the NCSIF is the 1% capitalization deposit, and that is 17.2 billion at 12/31/23. And of course, that does get adjusted as each year goes along, and it helps maintain the equity ratio of the fund. But keep in mind, because that 1% also resides on federally insured credit union's balance sheet as an asset, that created an issue, and that is why the minimum net worth ratio to be well capitalized is 7% for credit unions and 6% for banks. It's just strictly because of that 1% capitalization deposit. Because if the fund became insolvent, the credit unions would have to write off the 1% capitalization deposit, then they'd have to expense that 1%, and then they'd have to put the 1% back in there again. Certainly items that in the time frame of 2008 and 9 is like, wow, we can't let that happen.
The cascading effect. Yes.
Yeah. And so the NSF holds a balance of 21.4 billion in total assets and very little in liabilities, for basically a net position of 21.2 billion. Now it's interesting when you start looking at the deposit insurance fund's balance sheet as of 12/31/23, and it's nice to be able to explain some of these things that happen. They only held 24 billion in intergovernment assets at the time, Treasury investments, about the same as NC. And they had 23 billion in an assessment receivable that they were able to record as an asset because they knew the timing and certainty of the amount of those assessments coming in. Then they had 98 billion in receivables from resolutions, and that is from the 23 failure of three banks with over 100 billion in assets triggered the bailouts. FDIC used emergency authority to guarantee the uninsured deposits of Silicon Valley Bank and Signature Bank. As this illustrates, some creditors, uninsured depositors, may receive bailouts, but others, bondholders of the banks which were liquidated, did not. So that changed their balance sheet dramatically, at least for a certain measurement period, because they became receivables from resolutions.
Interesting.
Yeah.
Yeah, their audit must be a lot more complicated today than it was before that, and a lot more complicated than NCUA's is right now.
Yeah. Yeah. Yep. Yeah. Everything, when everything's running pretty good, everything looks really good. But when we have the big items that cause a bit of chaos, the accounting becomes really difficult, because I know establishing the accounting for the corporate resolution fund, that was extremely difficult and required us to use extremely smart people from outside the agency to assist with that number, because it was very complicated.
Yeah, I think those extremely smart people, when they were at NCUA, you could see a path on the carpet at NCUA from your office to where they were, to where the chief financial officer, Marianne Woodson, was, because those were some hectic times.
Yeah, I remember telling Marianne, you're going to have a tolerance for ambiguity for a little while. It goes shortly after she took the job, when all that happened. She was great.
Yeah, she was. That sounds like a good band name, or at least an album. Tolerance of ambiguity.
Yeah.
I'm going to Google that when we get off.
I think I stole that probably from Greenspan or somebody like that. But their fund had 122 billion fund balance. And the thing is, you go fast forward, by the middle of 2024, they were back up to 70 billion in intergovernment assets, and all of that position was starting to normalize. But their fund balance is 574% of the net position of the NCUSA. So there's a similarity between the size difference in insured deposits and the size of the fund balances.
Makes sense. So there's the operating expenses, there's the provision for loan loss, there's other topics along these lines. What would you like to highlight relative to the costs and the operating expenses, the provisions?
We can just run through basically the income statements way of each of these items, because everything that doesn't go or increase earnings kind of those funds is money out of the system. The big topic always there is the NCUA and so operating expenses, because every dollar the system has to put in to that is a dollar that's not available to cover insurance losses. So it's a big deal. So the total budget for expenses in the NCUF operating fund were 360 million for 2023, with 1,214 positions. The actual total expenses for 2023 were 377 million, the thing is NCUA has that combination of the operating fund, which takes care of federally insured credit unions. And then they have the overhead transfer rate that NCUS is charged by the operating fund for the services based on an actual allocation factor derived from ASPO usage for insurance related activities. So that money was a 62.4%. And going through the overhead transfer rate is like a whole discussion upon itself.
It is. Oh,
Yeah.
that's about a 3-hour podcast.
Yeah. So I just tried to just keep it as here's this kind of total expenses
Yep.
that in a system that don't go towards insurance. And it's at basically 370 million a year.
Joe Rogan can do 3-hour podcasts. Steve, you and I
Yeah.
probably should keep it short.
Yeah. The total expenses for the deposit insurance fund operating expenses in 2023 were 2.8 billion. And that their staffing level was 6,817, or we get back to the same percentages you see all the time, 561% of NCUA staff. So you'll see that follow along with almost all these measurements that the NCUSA doesn't appear really out of step. And they're in agreement with each other as level of staffing and some of these other measures that we look at.
Got it.
So the other item that, of course, comes into play is each of these funds has exposure to loss. And they both estimate losses determined on a fund's reserve methodology. And I was highly involved in moving NCUA pre-CECL as to how we would do it, and the losses given default and all the calculations that came into play. And I remember we're working in a room with a lot of people working on that analysis and complication. And we worked together and we'd ran some simulation, and we found that changing some element had changed a factor way out in a further decimal place. And they're all really happy about it. Oh, look at this improvement that we made. And I was like, yeah. And if I jump, I'm closer to the sun. It was like, I think we're there. I think we have a really good system if we are happy about something changing a way out the denominator. But that is a process that both of them do. It's similar to what unions do for their provision for losses. NCUA only had 3 failures in 2023, 6 in 2022. The cost of 1.4 million is all in 2023 and 9.8 million in 2022. At the end of 2023, one credit union was in conservatorship. The provision expense in 2023 was negative 12 million, and it was negative 39 million in 2022, meaning that the losses are less than what the analysis was projecting, and the institutions that generally were improving. So
Were you back in the corporate crisis and you had the audits that you were involved in? And I remember not from far, but from afar, that there was discussions about should NCUA have to consolidate their financial statement, the conserved credit union's financial statements into the insurance fund. And it was concluded it was a scary time, because if that was the conclusion, it was going to impact the numbers negatively. But they landed on the fact that they didn't have to do that. Do you recall any specifics tied to that?
I do remember that discussion, and because there was a chance that would create such gyrations in both our, because if we'd have to do it, we would tend to follow that FDIC was doing something similar. And you can see the gyration they had just with what they did in 2023.
Sure.
If you had that, you'd be like, these funds would be jumping all over, up and down all the time. And it probably would go against the very first thing that we're supposed to maintain public confidence in the U.S. financial system. And these wide gyrations just aren't consistent with that.
I like that. As far as investments that they can make, we've talked about the costs and the losses and everything. Any thoughts on the so the asset side and what the insurance fund invests in?
There's some similarity in that we can all only invest in basically treasury instruments. And generally the treasury doesn't want these type of institutions doing trading of the government securities or operating on and then rebuying them. They didn't care for that. It's interesting that the investment income for the insurance fund was 432 million in 2023 and 287 million in 2022. As rates went up, fund earned a lot more. It's interesting that the weighted average investment maturity for the fund in 2023 was 2.33 years. But you compare it to what FDIC, because of what they were dealing with at the end of 23, they were down to 0.21 years. Now, it is interesting also because of what they held. They only seemed to be holding some really high yielding stuff. Their rated average yield was 4.66 at the end of 2023 on a much smaller denominator than they normally had. And the weighted average yield for the NSF was 2.33%.
That's because of the ladder that NCUA had.
Yeah, MCUA does
ladder.
have the investment strategy that's put together. It generally had been a laddering was involved in it. I think they've done some adjustments to that, but I haven't kept up exactly what the
Sure.
nuances of the investment strategy are.
Very good.
But it comes down to, so who's better? They're both very healthy and both able to react with the situations that they have. So they're really hard to compare in terms of who's better. They're similar, but different. And we thought that might be useful information for this podcast.
Very good. Very good. You reminded me of an Alan Parsons song that I won't bore people with, but I guess I will bore them. Same with no similarity is the line of the song I'm thinking about.
Yeah.
Very good, Steve. There was a lot of chock full information there that basically points out, like you said at the end, you wrapped it up very well. They're two very good funds that serve this country well, serve the economic engine of the country, served us well when we were at NCUA, and will be robust into the future, hopefully. Want to thank you, as always, for your thoughtful analysis of this. And listeners, I want to thank you for listening, as always. This is Mark Treichel signing off with Flying Colors.